Let's welcome on board Ashish Gupta, CIO at Axis Mutual Fund, to talk about what he's making of the market right now. Ashish, so many trigger points, yet it doesn't quite reflect on the index, right? That's been
Yeah,
status quo pretty much for almost a year now. What do you
yeah.
think is going to finally make us snap out of this range?
Hi. Uh, no, I think we have had now through the last 6 months, first on the monetary side, positive action coming in from the RBI. And this has been followed on the fiscal side consistently, first on the direct taxes, when the income tax cuts were announced in the budget. And more recently on the indirect taxes, again, there has been a large rationalization. In addition to that, we clearly see that the government has increased in focus in supporting domestic demand and growth, given the headwinds we have around global growth and trade. So I think all these are positive. What continues to weigh on the market really is, in my view, is that while the pace of earnings downgrades has reduced, we have not started to see upgrades. And really, if you go back to 2022-23 period, there was a very strong earnings upgrade cycle that was supporting the market. And I think we are hopeful that with the recent actions on the both monetary and the fiscal side, there should be some degree of earnings upgrade starting to come through. I think clearly the earnings downgrades have bottomed out. I think earning expectations for this year are now very achievable at about 10-11%. Technically, I think the two things that weigh on the market is that despite the dollar weakness, we are not seeing a turnaround in FII flows. And equally, or probably more importantly, we continue to see a large amount of supply coming in terms of IPOs and stake sales. So I think that also weighs on the market, and that's kind of offsetting the strong domestic flows that we are seeing.
Ashish, can you give your take on the NBFCs as a entire basket? Because we're seeing some activity happening there. We have a new IPO coming up from Tata Capital, uh,
Yeah.
fresh buying by many of the funds in some of the undervalued NBFCs, which is there, especially Saman Capital. Uh, what is your take on the NBFC pack?
So we are actually quite positive on that space for multiple reasons. I think we are seeing some degree of recovery on the asset quality stress that was visible last year in segments like unsecured personal loans, in microfinance loans, and also NBFCs are going to be the biggest beneficiary of this change in liquidity stance by the RBI. We are expecting both margin improvement as well as acceleration in loan growth for the NBFC sector. And if we look at the financial pack as a whole, the rate cuts actually lead to margin contraction for the banks in the shorter term, but for the NBFCs, actually there will be a NIM expansion. So we are actually quite positive on the NBFC space across funds.
Hi Ashish, this is Harsh here. Quick take with regard to when you see the reversal in FII flows, because that could be one trigger that could well drive stocks within BFSI as well as IT, because those are the largest in terms of weightages, and those are the sectors which are likely also seeing a bit of headwind with due to the flows and all that's playing out.
Yeah, so I think it's actually been quite surprising this year. Typically, we have seen whenever there's a period of major dollar weakness, FIF flows actually turn positive towards emerging markets, including India. We have not seen such a swing this year. A lot of flows continue to kind of go into the US market, or in other markets, actually, most of the flows continue to chase the AI plays. So even if you look at markets like China, Korea, Taiwan, who have been the better performers this year, most of the flows have actually gone into the names that are really AI beneficiaries or seen as AI beneficiaries. So I think we need to see some of this chase towards this theme moderate in addition to continued dollar weakness for flows to turn positive. Uh, and in fact, one good sign I have recently seen is that in the last 3-4 months, FDI flows into India have started picking up. So while FII flows have not turned positive, FDI flows into India in the last 4 months have turned positive. But yeah, it's a $1 billion question: when do the FII flows turn positive?
Ashish, CRR phase cuts have begun, but at the same time, you have a policy coming up on Wednesday. Do you expect a rate cut or a pause in that policy, and what kind of commentary are you looking at?
So I think two things. One is that clearly post the GST rate cut, as well as the last two inflation prints, it's likely that RBI will lower its inflation target. So next year sorry, not target, inflation expectation. Its inflation expectation for next year is still 4.8 or 4.9%. And the GST rate cuts alone will mean that should drop by about 50 basis points or so. The weak oil prices also mean that there's potential for some cut in petrol and diesel prices. So I think as RBI lowers its inflation projections, there will be room for the rate cut. Whether it happens in October policy or December policy remains to be seen. Equally important is that I think RBI has to potentially provide some comfort around how it sees the yield curve, because since its last rate cut, 50 basis point rate cut, actually bond yields at the long end have trended up, and yesterday they were more than 6.5%. So I think in addition to the liquidity infusion, I think some commentary around potential open market operations will be needed to really drive a rally in the bond market.
I think the yield curve is inching up despite the fact that RBI is pushing the rate. Is the transmission not happening, or what is the reason for that?
So actually, on the lending side, the transmission is happening. In fact, that's also reflecting the weak credit demand. So if you see mortgage rates, they are well below 8% now. There are banks giving mortgages at 7.5%. If you see gold loan rates, they are down to 17, 18%. If you see top corporates, they are actually borrowing just around 6% at the short end. So transmission is happening. What we haven't seen is a pickup in credit demand. I think the challenge more has been on the bond market, where just there has been a demand supply balance. The buying from insurance companies and pension funds has been relatively muted. So at the long end of the curve, there's a demand supply balance, and that's where probably some open market operations are needed.
Not wrong, your positive capital goods. Could you give us that perspective? Also,
Sure.
capital goods likely to face some headwind because of tariffs. Would that be the right angle to look at this? And would that be a risk? And how are you kind of playing that?
Yep. So I think one thing we have witnessed over the last 12 months is that most of the capital good companies have actually been able to maintain their earnings and, more importantly, margin. So even in the last quarter, that was one sector that not only delivered good earnings growth, but also met the expectation. And one of the key reasons we continue to be positive on, while there have been some concerns around pace of government capex slowing, etc., uh, we look at both government and private capex, and we find that that is still growing in double digits. There are some sectors, whether it is EMS, defense, power, we continue to see scale up in capex plans of companies. So we are quite positive in these select verticals of capital good place.
Okay. Right. Ashish, great to have you on the show. Thank you so much for your time today.
Thank you.